So from there, I'd like to now just move on quickly. In the interest of time, I'd like to invite on stage Arvind from C4D and Syna from trica to come up for a fireside chat. Syna, as we all know, in her past life, she's been with CNBC, and we've all seen her on the television. And Arvind, I would like to thank a lot for sponsoring our conclave as one of the lead sponsors. So round of applause, everyone, for both of them. Over to you guys.
Thank you very much, Amit, and thanks for joining us today, and welcome everyone to this curtain raiser on maximizing LP-GP relationships. Now, as there might be as many definitions of technology as there are definitions of what really constitutes impact investing. So just to set the record straight and to have everyone on the same sheet of paper, Arvind, you want to explain to us from your perspective and the funds that you manage at C4D. Give us an idea of how you define impact investing, and then let's take the conversation from there.
Sure. So Syna, for impact investing, I would say there should be three strong pillars. One is with respect to, there has to be a balance between impact, financial return, and the tech play. Okay. So usually what we hear is we are an impact first fund manager, we are a financial return first impact fund manager, we are a tech first manager. I think it has to be a balance between the three. The second comes from the exit strategy point of view, that as an impact fund, how is your exit strategy aligned with the promise of patient's capital that you have made? Usually what we see is, with respect to the exit strategy, the timeline and everything, it's very much in line with what you see in other space. So that has to be there. Third, I believe, which is very critical, is with respect to alignment of interest between LPs, GPs, and portfolio beyond financial returns. Today, unfortunately, the benchmark with which impact fund is looked at is same as a financial return and nothing beyond that. And that alignment is missing, so that alignment has to be there. These three critical factors, I would say, was define you as an impact fund versus a PE or a VC fund. Okay,
fine. So we'll take each of those up, Arvind. Let's start first with the definition of the impact fund, right? Or impact venture fund, or a social venture fund in the Indian context as defined by various SEBI regulations and so on. You believe that there is a little bit of a misnomer over here, because a regular venture capital fund that invests in technology companies, and we can debate what technology is, in much the same way that Mr. Munjal dedicated a few minutes talking in his opening address about the upliftment of rural artisans and rural development, right? So let's think really about, therefore, if you can elaborate for us what the SEBI definitions of a social venture fund are and how those are perhaps doing a disservice to what the longer impact of patient capital in the impact investing space should be. If you can elaborate on that for all the LPs that are here.
So I think an impact fund with respect to strategy should be more similar to a PE than a VC. So, what would, in my mind, India needs with respect to impact investing is more like early stage PE investment strategy. So PE is not usually early stage, and when we say early stage, it's more of a you need to be away from VC, where it's very fast paced, and the way matrix works is very different than a PE, and the strategy is more focused on cash flow, sustainable growth. So it should be more aligned to PE. But if you look at the alternative investment space in India, SEBI registered AIFs, we have three categories. The second is for private equity funds, and third is for VC funds. And today in India, most of the impact funds are actually registered as a VC fund. There is an option of getting registered yourself as a social venture fund, but that model is not viable. So if you compare a social venture fund category, subcategory in Cat 1 and a VC fund in Cat 1, there is only two main difference between the two. One is the social venture fund says that you can take grants and give grants. In my mind, impact fund should not be in the business of taking grants and giving grants. That's for not-for-profit. They have been doing a great job. Why, as an impact fund manager, you want to take grants and give grants? That's not investing. The second point, which is a differentiator between the two subcategories, is as a social venture fund, and earlier it said that the fund can lose capital or deliver muted returns. Now it has been changed and it says it has to deliver muted returns. What is muted returns? Nobody knows, it's not defined. Again, why should, there should be that restrictions? There are no other advantage if I register myself as a social venture fund versus a venture capital fund. And because of those, we see all the fund managers in impact space are registered as a venture capital fund. And unfortunately, if the inputs are same, the output is going to be same, and which is what we are seeing today. Everybody is operating like a venture capital fund. So for impact fund to establish itself as a sub-asset category in the alternative asset class, I think social venture fund category has to be made viable.
Okay, and how could it be made more viable? I mean, let's talk about, some very practical aspects of it. Perhaps a longer fund life. I think a lot of GPs here would even argue that, a 10+2 fund life or just a regular venture fund is also not adequate, right? Let alone for an impact fund. So if you can talk us through, in your mind, what could be some of the solution statements towards making impact investing more fruitful from a GP's point of view?
Yeah, you rightly said, a 10+2 is not a right fund life even for a PVC fund. This is more of a copy-paste.
In India?
In India. In not just India, I mean, it's also other countries. If you look at in Asia, Middle East, it's the same structure which has been copy-pasted from the West. It worked there because the market is different, the public market, the domestic participation, all those are different. So it doesn't work in India, but it has been copy-pasted. Similarly, for impact fund, the same structure is copy-pasted. I think some of the changes we need to do is one with respect to the fund life, as you rightly said. Now we need to balance. I mean, if you change the fund life, it also changes the management fee, which a GP will have to, LP will have to shell out. So can we think of a structure where the management fee is slightly lower than what you see in the sector, a higher fund life? Even if that cannot be done, why not think of a lower commitment period or investment period of 4 years in the same fund life so that the holding period is at least 6-7 years? Then second is, how do we align? Today, as a fund manager, a VC fund manager and an impact fund manager are incentivized similarly for the financial return they generate. So can we think of a structure where you have to align your incentive beyond financial return? So how do you capture at least one key KPI which you are targeting as an impact fund manager into your incentive model? So these are some of the things which needs to be done as a regulatory body for SEBI. We need to look for how somebody in a social venture fund they can get some advantage compared to a VC fund. Even the portfolio companies, the social entrepreneurs who are solving problems, how can they get some advantage? Beyond today, the argument is that you are getting funding, that's the impact we are creating, otherwise nobody will touch you. So that's what you are getting with respect to upside. I think it should be beyond that.
Okay. I think let's come and now maybe look at it from the other lens, right? Simply from a LP perspective, I think there is a lot of ambiguity on how do you even measure this impact, right? And to your mind and from what you observe globally as well as what you all do at C4E, can you give us a sort of framework? And if I may, frame the question in a way to ask you, what are the really tough questions that you believe LPs must ask of GPs when you go with a proposition of having them invest in your impact fund? How do you define what that impact on ground is going to be? How do you define what kind of rural upliftment for artisans you will do? How do you measure that? And if you can talk to that, I think it will be really good. You could share some examples from your own portfolio companies and what you all have been able to do successfully.
See, having one definition of impact is going to be quite difficult because we have a lot of societal problems that needs to be addressed. So as a fund manager, I think based on our expertise, we need to identify that one or two key KPIs. And I'll give an example of what we have done at our fund, in our first fund. We had a focus with respect to gender diversity. So what we said is that at least 30% of our capital has to be invested in women-owned led enterprises. If we are less than 30%, then our carry percentage starts decreasing. And if we are more than 40, then the carry percentage starts increasing. So that's one factor which we gelled with our incentive of carry. If we look at our portfolio, today we are at 42%. So 42% of the total AUM is invested in women-owned led enterprises. In our second fund, what we are trying to do is how we take it to the next level. How do we look at gender inclusion in the value chain of the portfolio companies? So similarly, another fund, if they have a target with respect to artisans, right? So depending on the fund size, how many companies they are going to support, at what level, and initially things will go wrong. We might have a very high target, we might have a very low target, but this is the process which we'll have to go through. I think at least one KPI has to be identified, which the manager is promising that we will deliver. And once that is done, I think the question also arises, if I don't have that and I go to an LP should ask, okay, how is your incentive aligned with what you are promising? Today you generate a financial return, but the impact is not there. What happens? Similarly, the question has to be asked, if you are saying you are an impact fund and you are giving patient capital or risk capital, how are you displaying that patient in your structuring, the fund structure? So some of these questions has to come. Unfortunately, the questions are again very traditional. What is your gross IRR? What is your net IRR? What is your DPI?
What are the muted returns?
Exactly. So these are the questions which comes, and the question has to move from these.
So what would you like to see balance out between returns on ground and the muted sort of financial return, right? What's the balance between that? What have you noticed in your own fund or globally that Indian LPs can perhaps take some guidance from?
So in my mind, it should be between a debt return and a VC fund return. Now, if you look at the, a lot of people might not like it, but if you look at historically with respect to...
It's okay, people cannot like Arvind. Yeah. That's the point of having a small closed door conversation.
Yeah, so, if you look at historically how much has been delivered with respect to what has been promised when it comes to PE, VC fund globally, it's way off. It's way off. Everybody without any thinking, there is a standard promise. Oh, we will generate 25% plus return, irrespective of the strategy, irrespective of the region, irrespective of what you do. That's the standard promise. But if you look at what has been returned to the LPs, it's much lower than what has been promised. So that sanity has to come. But as an impact fund, I think anywhere between a debt return, which could be, let's say, 12 to 14%, to a venture equity fund return target, which they say 25-30. Between that is where impact fund should sit.
Okay, I think one or two topics that we can quickly cover before we wind this up is also the over-allocation of impact funds into certain domains or areas in India traditionally, right? A decade and a half back, we had microfinance, and I think the whole world and its neighbor was investing into microfinance in India, directly or through funds of funds and so on and so forth. It seems to be the season of EVs, and perhaps agri-tech is next. And this is not just an India phenomena, it's a global phenomena, right? The clustering of what gets defined as the big impact objectives for a decade, and then everyone goes into that space and creates perhaps, vitiates that space more than they are able to deliver outcomes. Your own thoughts on that?
Yeah, we don't consider MFI investing impact investing anymore, and I think nobody should. The sector has gone through the entire cycle with respect to grant funding, impact funding, commercial funding, IPO. Now it's just duplicating what has happened and duplicating it fast because there's a lot of money flowing into it. And if you look at the heated district chart of India, and it's quite worrisome. There's no product innovation, newer markets are not being explored, and multiple players in same districts, and it's quite bad right now. So it's a negative impact which is being created because there are borrowers who are having multiple loans. So it's a debt trap which is being created by MFI. And unfortunately, you look at the investing space, and as you rightly said, globally, one sector moves out of favor, and then there is another sector which is built up. We saw what happened in EdTech. I feel similarly, something we will see in EV space. There's a lot of interest in environment or climate funding, and the lowest hanging fruit is EV. So everybody is running towards EV. So same agri-tech, for example, if you look at a lot of agri-tech companies are largely focused on consolidating the produce. It's post-harvesting where the focus is rather than pre-harvesting. A lot of money has to go into pre-harvesting. EV, a lot of money has to go into developing the technology rather than just the service. As Mr. Munjal was saying, that we as a country has lagged behind when it comes to manufacturing. It's services. VCs generally tend to fund services because that can grow faster and you can play the valuation game. It's the manufacturing where the focus has to be there if long-term growth or India has to establish itself as a global player.
And what can global impact funds do in India? What are they doing globally to address some of these things differently from how VCs do? So I think it's the last question. Global trends that you're observing and how some of those best practices could be brought here.
So I think
if there are global good practices.
No, there are definitely. I mean, it's not like nobody is focusing on right set of things. I think it's also because India has seen a lot of focus with respect to VC and impact investing, and right now the lines between all these investment strategy has kind of blurred. But we have seen a lot of good examples globally with respect to how impact investors are providing that risk capital for another investor who might not be as commercial but not be as impact oriented to actually also participate. I mean, in our own fund, for example, we started as a subsidiary of an NGO. When we kind of spun out our parent company, Eco Corporation, they actually gave us risk capital for other LPs to join. So they kind of gave us first loss capital. So there are a lot of these structures which I'm seeing right now happening in Africa, for example. There's a lot of mix of capital which is going on. And I think that is also required in India when we talk about impact investing or VC investing. In impact investing, largely as a GP, we have to depend on global LPs. So most of the funding comes from global LPs. The Indian investors, be it fund of funds, family offices, HNIs, I think have to increase participation in impact investing, and that balance has to come, which we are seeing globally but not in India.
Okay. All right. Any questions from the audience? Yeah? Yes.
Arvind, those were really insightful comments and observations. I didn't get your point which you mentioned about carry incentive, and you mentioned it in the context of impact. Could you dwell a bit more on that?
Sure. So as a fund manager, we have the carried interest, which is, if you look at the sector, it's 20%, right? 20% of all the profit comes to you. What we did is we, instead of having a fixed carry of 20%, we linked it to the impact objective. So you get carry when there is a financial return, but then how much of that, the percentage is decided on the impact promise that you have made. So we made a promise that 30% of the total AUM has to be invested in women-owned led enterprises. And with every percentage drop from this 30, we have a percentage drop in our carry percent. Then we had a floor and a ceiling, but what we are saying is that if we give the financial return, but if we underdevelop on the promise of the impact, we should make less incentive. So that is something which I believe as an impact fund, everybody should have one KPI linked to your incentive, because that's where what will drive you to do what you are promising.
Thank you, Arvind. And if there are no more questions, I'll hand over to Amit once again to take the afternoon forward.
Thank you.
Thank you very much, Syna and Arvind.